on TV, online and on your smartphone. This is Ticker News.
This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd and this is Talk Your Book, and today we're lucky to be joined by Harley Grosser from HD Capital Partners. Harley, thanks very much for coming back on the show.
Pleasure, Chris. Thanks for having me.
Now, walk me through, for people who haven't heard you speak before, a little bit about HD Capital Partners and what your investment framework looks like.
Sure. So HD Capital Partners is my business alongside my business partner, Dan Sims. We have a relatively open mandate, but our focus, most of what we do is in small cap ASX listed companies. We're fairly high conviction. We tend to take sort of 10% position sizes for stocks that really stack up for our process. And we're value investors, so we like to buy things at big discounts what we think they're worth, run by management that are aligned, a long history of track record, and we like companies that are fairly easy to understand. We don't do venture early stage stuff. We like profitable cash flows and typically companies that we can go back and look at their accounts 5, 10, 20 years and see how they've operated, so we get a good feel for what they're going to do in future. And
what stock did you want to talk about today?
Today I want to talk about Airtasker, the code's ART.
And talk to us, give us the helicopter view of Airtasker, sort of what their business model is and what they do.
Sure. So Airtasker was founded in 2012 by Tim Fung and Jonathan Louis. It's still founder-led. Tim's the MD. He owns 10% of the business. To explain what it is, it's an online marketplace for local services. So there's two sides. So on one side, there's the user. That's the person that goes on the platform and posts a job, and that job can be literally anything. There is a group of tasks that are most popular, so things like gardening, cleaning, tradie, assemble some furniture that you've bought, but it can literally be anything that the user wants to post. And on the other side is the people completing the jobs, which are called the taskers. The task is similar to an Uber, gets a rating and over time builds that up. There are tasks that earn well into 6 figures doing work on the Airtasker platform.
And what are the different geographies in which they operate?
Yeah, so there's 3 geographies, Chris, that they operate in. The main one is Australia. That's where they have their most established business. There's $250 million worth of transaction value going through the Aussie platform, generate about $45 to $50 million of revenue. And on a run rate basis, it's $14 to $15 million of EBITDA based on the first half, $7.5 million number. We think the basic thesis is that we're getting the Australian business for a discount to what it's worth at the current price and the price that we've paid for our fund. Also getting optionality over the 2 other geographies, which is the UK and the US. These are much smaller than the Australian business, but they're fast growing, and there's a few deals they've done lately and some deals we'd expect to come in coming months that we think will sort of kickstart the growth there and the market will start to get interested.
And you mentioned the UK business, albeit reasonably small at this stage, but growing really strongly. Give us a brief overview of just how strongly it's growing. And they also point to recent media deals they've done in the UK, assisting in that growth. Maybe talk us through the growth and then what those media deals that they've done in the UK look like.
Sure. So the growth is, I think it's about 70% over the PCP. So it's growing really quickly. It's off a low base, probably run rating at a few $1 million Australian at the moment. What Airtasker did to grow the Australian business, or partly what it did to get it to the point where it is today, was a media for equity deal with Channel 7, which everyone in Australia would know well. That was very successful. And I believe they're emulating or trying to emulate a similar model in the UK with a group called Channel 4. Which is a free-to-air TV station in the UK, reaches almost 50 million viewers every month. What they've done is they've done a media for equity deal, about $6 million worth of equity for 20% of Airtasker UK, so the actual subsidiary that operates in the UK. And over that period, out to FY28, they'll basically get $6 million worth of advertising. And at the end of that period, they'll have the option to buy back that stake, either at equity, based on a revenue multiple that the headco stock is trading at, or for cash. So they have the option there to avoid dilution depending on where the stock's trading and how much cash flow the business has generated. So really, we know that the platform works because of the success of the Australian business. We know the model works. We know there's lots of happy customers and lots of happy taskers. The question now is how to get that awareness of the brand out there in the UK market and then eventually also in the US market. And we think this is a smart way and a relatively low dilution way to get that done.
And they've just signed some similar deals here in Australia. Talk us through the quantum of those deals and any sort of nuance around them as well.
Yeah, so the Australian business is really interesting. Obviously, a lot of the growth, or the faster growth, is coming from UK and US. We think there's a massive opportunity in the Australian business as well. Airtasker has really good brand awareness levels. There was one study, I think it was over 60% brand awareness for Australians. But I think that's different to being front of mind when you actually make a purchase decision, like an Uber would be. So we think that there's a massive opportunity to keep growing that just by getting the Airtasker brand out there. If you look at FY24, it was a pretty important year to look at the business because, as we know in public markets, there was a big shift towards being free cash flow positive. And so Airtasker pulled back massively on their general brand marketing spend from $10 to $20 million in years prior down to a pretty measly $2 million a year and still generated $40 million of gross profit in that year. That's an excellent return. And what they've done now, which I think is quite clever, is 2 media for equity deals structured as convertible notes, in total worth about $11 million. One is with ARN, so everyone would know Kiss FM, Kyle and Jackie O, some of those big names. And then also O Media, which is the largest outdoor media business. So you'll see billboards, bus stops, sides of buses, retail centres, things like that. So we think that they're going to actually kickstart growth again in the Australian business through those deals. We think they're relatively well structured, low cost of capital. The convertible notes, I think, are at 5.5% or 5.8% interest. And we think that's going to be probably going to kickstart some of the growth in Australia as well.
And how do those deals get accounted for?
Yeah, so it's media for equity. So if we take, say, the billboard deal with or outdoor media deal with O Media, if there's $5.5 million of advertising value there, you'll see an amortization of that convertible note as they recognise the advertising spend as it's incurred, but you won't see the cash transaction. So what that means is that cash will look better than the P&L over the period of the agreement, which we think is smart. We think it's smart to conserve the cash, get the growth in. We know the business works. There's heaps of leverage there to generate earnings as revenue grows, even off a small base. And then have the option to buy that back or pay back that convertible note.
And when you're looking at their drive to be free cash flow, whilst it won't be accounted as cash, do you still sort of subtract that internally to view where they're tracking versus where they would be if they were just buying that advertising as per the usual route, or you really do treat it as a non-cash item when you look at it?
No, it's definitely a real expense. It's a non-cash item from the perspective of the accounting treatment, but it's a real expense. But we think that the way that marketplaces are interesting businesses, we think they're very hard to build because you need to get to such a certain scale just to be worth anything. But then when you get there, they become relatively self-sustaining. And then I think every few years you've got to sort of stoke the fire and get that brand awareness out there. So FY24 was a year where they really spent almost nothing on that general brand awareness. Now there's a huge opportunity to invest in that. And so there is going to be a heavier investment over the 2 years that those 2 deals worth about $10 or $11 million go through the books. But it's not necessarily a recurring expense you do every single year. It's kind of just reigniting the fire of getting that brand awareness front of mind. When you want to get your gardening done, when you want to get any task done, you think of Airtasker, and that's kind of what they're intending to do with those deals.
And I guess there's a flexibility you normally don't get with a traditional expense. If you just pay that money in cash, there's no flexibility. Whereas if Airtasker's stock price rips, all of a sudden you could do a small raise, pay the cash back, you've lost 5.5% coupon and much less dilution than you would have if you were raising capital at these prices.
Correct. I mean, 5.5% is probably better than a big four bank. That's a really low cost of capital for a listed small cap tech business. So we think from that perspective, it's clever. If the stock re-rates to where most sustainably large, profitable marketplaces do trade on, which is much higher than where the current share price is, then they can do what you just said. And if they don't, then they can pay it back with the cash on hand. Their balance sheet's quite healthy. So there's some optionality there, and they're giving them themselves a few costs of capital options there, depending on where the stock trades when the deal reaches its maturity.
And it looks like there's a number of these companies that when they were born or certainly when they listed and post the initial COVID phase, all the emphasis was just on top line growth. And then all of a sudden there was a cost of capital again and rates rose, and all of a sudden the bottom line became really important. It looks like they've done a good job of getting their cost base under control. What are some of the initiatives they've done, and maybe speak to a little bit about the headcount changes to sort of get that cost base under control?
Yeah, so I think it's important to, when you're looking at the cost base and the different segments, to split each out. And so the Australian business, there was a lot of cost pulled out of that. Like I mentioned, they'd substantially reduced the general brand awareness marketing spend from $10 to $20 million when they were listing each year down to $2 million. So that's obviously a big portion. They've cut costs elsewhere in operations. But the Australian business is still very profitable. It's generating lots of cash, but then they're using that cash flow to then fund the UK and the US growth, because they believe in the enormous upside which is there, which we obviously agree with too. So you've sort of got to split those both out. At a consolidated level, they're roughly a minor free cash flow positive, but it really is about reinvesting all the excess cash flows of Australia into potentially what could be much larger business in the UK and the US.
And a big cash balance. I think they've got about $17 million cash in the bank or thereabouts. Where do you see the main driver of that being used? Do you think it will be more the UK, more the US, or alternate things?
Yeah, I think, well, a lot of the growth, because of these media for equity deals, a lot of the increase in advertising spend will be non-cash for the time being in the UK. They haven't signed a deal like that in the US, but them to do so. It'll look similar to the deals they've done in Australia and the UK, would be my assumption. That's not guaranteed yet, but we'd expect that they're working on that. So we don't think there need to be too much cash flow to support that. I think a really important point to make here is that the platform is built, the platform is successful, and it works in Australia. The money that they're spending on growth is really marketing. It's just getting the brand out there and making UK, US, and still Australian consumers and taskers aware of it. That's very different to investing a fortune in ongoing platform development costs. They don't have to do that here. If there was a point where they needed to turn off the marketing spend, they could do it. And so you have that cash burn risk much lower than if they were constantly reinvesting CapEx to build out an ongoing platform that wasn't yet built. So yeah, I hope that answers the questions, Chris. We think most of it's going to come from the media for equity deals.
And give us an overview just of the numbers, a bit about their market cap, what their rev is now, where do you think it can grow to in the next year or so, and what you're looking at from a free cash flow perspective as the overall group.
Sure. So at about a 30-cent share price, it's roughly 135 mil of market cap. As you said, 17 to 20 mil of net cash, call it 120 mil EV. If you look just at the Aussie business, we call it sort of $15 million of cash EBITDA. It's a clean EBITDA. There's not a whole lot of CapEx that's being, or development expense being capitalized there. So we think that if you look at multiples of these established marketplaces overseas, they tend to trade on substantially higher multiples. We think the Australian business is worth 40 to 50 cents in its own right. Growth in the Australian business was modest for the FY24 period, but we think that's a reflection of their reduced marketing spend, which will, as we know, ramp now from the deals with ARN on radio and oOh!media for outdoor media. So we think Australia will accelerate. Exactly what, we're not sure, but we feel comfortable that we've paid a price well below what Australia is worth. And then UK and US can kind of be anything. I mean, your guess is as good as mine. And the way we kind of approach investments is, as long as we can pay a price that reflects a big enough margin of safety for the core profitable business, the Australian business in this case, then we're getting UK and US for free, and they're kind of options that we get based on execution by management. So UK is growing very quickly. You wouldn't be shocked if it doubled year over year from here, but still off a small base. One thing I would add that's quite interesting with marketplaces is that you can actually go back and look at the data for this in the Australian business, is that in the early days, the marketing spend kind of ramps in line with the unique users and with the total transaction value each year. And then eventually it gets to a point where you can actually pull back on the marketing spend, and users and transaction value keeps growing. And that's a function of these marketplaces. When they hit scales, they start to become self-sustaining. With an Uber, you don't walk out of your restaurant or walk out of the pub and then see an ad for Uber. You just know you're going to get an Uber home. And I think the opportunity in Australia and then eventually UK and US is the same for Airtasker, but for local services. If you're at home and you need your garden done, your end of lease and you want the house cleaned, or in the case of Airtasker, it can literally be any task that a user thinks of. You might need, I saw this morning on the platform, somebody to go down to the local court and file documents for you, or somebody to optimize your home Wi-Fi, which is probably popular now than it was years ago because of all the work from home. Whatever it can be, Airtasker has an opportunity to be front of mind for someone to post that job on the platform.
Well, really clearly explained. As always, it looks like it hits a lot of the things you're looking for. Founder-led business, looking to become cash flow positive in a pretty easy to understand business model with a chunky economic moat. So thanks very much for coming back on the show. It was great to have you on. And to all the viewers out there, thanks very much for watching. We'll be back this time next week to do it all again.
You're watching Ticker. We'll have more in just a few minutes.